Good morning, everybody. It is Monday, January 17th, and I can't see hardly any snow out my window in Wisconsin in the middle of winter. I love it. Can't wait till it's tropical here. Just teasing. I'm going to make this kind of informal, seeing as the market's closed today. Just going to go over a few things. I have been really reading a lot this weekend, and this is the Forest for the Trees report. And they've been talking about how the dollar could collapse. And the thing is these Austrians have been talking about that my whole career. And for the last 9 years, the dollar's been rising. But if you listen to people like Stanley Druckenmiller and other dollar bears, what they're saying is that with the massive amount of retirement obligations coming, that's going to be bad for the dollar. Obviously, you've heard me talk about the boomer bust hundreds of times by now. And I have pegged that towards the end of the decade. Depending on the studies you read, could be as early as 2026 or 27, 2031, 2, 3, 4, whatever. It's late this decade, early next decade, when we have to face the reality that we're going to have rising Medicare costs and Social Security will be pretty much maxed out. Now, here's the good news. The good news is that Social Security is really not a problem. There's plenty of money for that. It doesn't take much tinkering to keep that going till the end of the century. Even now, with not doing the things we're supposed to be doing, Social Security is 70% funded till the end of the century. So people who talk about it going bust are just silly. It's not anywhere close to going bust. Medicare, on the other hand, is a problem because in the last year of life, we usually spend a lot of money taking care of ourselves. And I don't know if COVID changes that, because one of the interesting things, and maybe the most interesting macro impacting thing from COVID, is that about 70%, a little over 2/3 of the deaths are for people with significant comorbidities. And that means that people who are likely to stretch things out for 2, 3, 4, 5 years of expensive care are dying quicker. I'm not advocating anybody die. However, from a standpoint of cost benefit analysis, or at least just what it's going to cost to take care of ourselves at the end of life, at least at this moment in time, pre really good vaccination, we have 2/3 of the population getting vaccinated, but these vaccines, although they reduce symptoms and the severity of the illness, it's not really preventing us from getting it. That's because it's still evolving. It still has a lot of mutations, and it's changing the same way that flu changes from season to season, or every other season, or every third season. So we're likely to see COVID around forever, just like we have the flu around forever, until somebody, maybe over on the Ginkgo Bioworks platform, decides, hey, look what I found. I think this might be a cure. And I think that we'll have that aha moment someday, just like it looks like we're getting closer to it on cancer. But just like geologic time, where a decade is but a blip on a map, in biotech, probably get rid of a couple zeros, we're still talking a generation of research away, probably. So 10 to 20 years is probably when we'll start seeing a lot of today's diseases finally getting their cures, or at least incredibly good treatments that are cheap. So for the next decade or two, we probably just have to watch the evolution of biotech platforms like Ginkgo Bioworks, or the evolution of mRNA at Moderna and Pfizer and some of the other companies that are getting into it now. When it comes to the macro, though, what does this all mean for the United States? Well, I think it means that the dollar isn't as doomed as people think, because the expenses that we're going to have to spend on Medicare probably aren't as high as people think. And that's, not a wonderful way to look at things because it means that people are going to be dying quicker. But it probably amounts to hundreds of billions, if not trillions of dollars over the course of the boomer generation. Because I don't believe that about a quarter of them are ever going to get vaccinated, maybe 20%, but it's a 20 something percent number probably. My cousin was an anti-vaxxer. He wouldn't get the vaccine. He just died after being on the ventilator for 2 weeks. What are you going to do? So in his case, like 2/3 or more of the others, he had serious comorbidities, high blood pressure, alcoholism, other things going on. So we'll see how that all plays out. Ultimately, one of the arguments against the dollar, though, is the whole demographically driven idea that aging demographics will just be super expensive and slow down the economy. Well, they're adopting the argument I've been making with slow growth forever, going all the way back to 2012. I've been talking about this. Druckenmiller bragged that he brought this up 7, 8, 9 years ago. I was like, well, I brought it up in 2012. So, that's about the same, right? Maybe I was a little ahead of him. We have to keep our eye on that because ultimately the value of the dollar is relative. What do I mean by that? Currencies trade against each other. Right now, the United States is tightening, and China announced last night that they're going to loosen. So the dollar should go up in value versus the yuan. But there's a basket of 8 currencies that we measure against, and I've showed that chart quite a few times. I don't believe that the dollar falling right now, which is unusual when the Fed is tightening, is going to be very long last. I think it's going to run its course into the summer, maybe, and then you're going to see the dollar turn back up. And there's a number of reasons for that. One, Build Back Better will get passed, and it's probably going to be budget neutral because Manchin is demanding that. And I think that's great. As you know, one of my theses is that the United States, given all of its huge advantages economically, could become a gigantic Switzerland-like financial structure. We could become so rich in the next couple of decades as the dollar goes up in value and we get past the petrodollar era. If the dollar rises, it means that the entire middle class and everybody, and below and above is going to have a higher standard of living because we'll be able to buy more things with our dollars, more purchasing power. But during the periods of change in the value of the dollar, the asset price levels have to adjust to an appropriate equilibrium. So let's suppose that the 10-year treasury stays in a 2 to 3% range for a long time, starting a year from now. And then it never really gets up to 4 or 5 because we don't need it to. A 10-year treasury at 3% and a 20 and a 30, a little higher than that, everybody in the world will start pouring money back in the United States. And that is actually one of the things in the last year that hasn't been happening. We've seen foreign outflows most of the past year, about $500 billion. It's not a ton of money, but it flips the equation because we had $500 billion to $1 trillion coming in most years. So ultimately, what we have to see is the foreign capital inflows come back to America. And that is one of the key things that I've talked about this before that we have to watch. So when foreign capital inflows have a reason to start coming back into America again, shortly after that, the price of our assets go up again because they start to buy real estate when they get past the fear stage, and they start to buy stocks, generally QQQ. So right now we're in a period where foreign direct investment is low, and that's one of the reasons the stock market is weak. That, along with the dollar, appreciated for a while. Now, one of the narratives out there is that the Fed is going to raise rates 4 or 5 or 6 or maybe even 7 times this year, and that they might start as early as March. I would throw something out there. I think that stretching out the rate rises over a long period of time and then starting to run off the balance sheet by the end of the year or next year of the Fed is the wrong approach. And it's not a matter of should it be done, it's a matter of when it should be done and how it should be done. I believe that this inflation is transitory. because it's mainly tied to supply chains. And we can prove this. We have proved it. It's tied to supply chains and OPEC manipulating oil up, but we're really kind of near the top end of that. And rents are high, but we know that there's a ton of housing coming on the market this year. Rents are probably going to levelize. They're not going to come down, but they're going to flatten. So we're going to lose the inflation from rents rising. We're going to lose the inflation from the price of energy going up. And we're going to lose the inflation as supply chains normalize. There's no reason why we need to push wages down or cause a recession. And perpetual tightening by the Fed could cause a recession. What I have suggested, and I sent it in text to the Federal Reserve, or a tweet, you can find it on my Twitter page, is that what they should do in a few weeks is announce that in February, that is the last amount of money going into the market. The QE is over with as of right now. And I think that they should raise interest rates a half point on the Fed funds rate in February. I think they should shock the market. I think they should end QE a month early. And I think they should raise interest rates, not a quarter point, but a half a point, and take a serious shot at inflation once and for all. Shock the market, because then everybody will believe they're going to be really aggressive. Then come March, they should say, hey, we're going to wait and see and be data dependent before we raise rates again. In essence, I think that they should shock the market and then go on vacation. Why? Why does that make sense? It makes sense. Remember what I've told you. Things that make sense often happen, usually happen. Something like this, we'll see. Powell is cagey. But if they shock the market, all the adjustments that we're going to get weaned out over the course of a year and probably be a mistake at some level would happen all at once. We'd have a really wild and probably big downturn from the announcement into March. And then in March, when they said, hey, we're going to wait a little bit and be data dependent, now all of a sudden the market would be, wait, is he pivoting back again? And it would just create price discovery. And in that amount of time, that 1 month, when everything kind of paused to see what the hell was going on, that's another month the supply chains normalize. And we've seen the ships getting unloaded much quicker since Biden threatened them. And the dollar goes up, starts going back up again, pushes prices down, including oil. And if they're smart, they get Build Back Better passed during that month, or at least around the Fed meeting, and it's budget neutral. If they do these things, now all of a sudden, we have gotten a tremendous opportunity to trade and buy low probably. The economy starts to normalize. Hopefully COVID doesn't rear its ugly head again, not any worse than what we've been seeing. And going into summer then, the world's a better place. And now slow growth forever just starts to become slow growth forever again. But because we're rebuilding the world, it's not quite as slow. And we just get what I'm calling the great divergence. The things with secular tailwinds are going to do well. The things with secular headwinds aren't going to recover. That's why I tell people, stay away from things like oil pipelines. North American oil pipelines are only 52% at capacity. They normally run at 70%. Even with an increase in Permian oil, they're not going to get anywhere near 70% capacity again. In the meantime, these oil pipeline companies, which are consolidating because they know what I'm saying right now is true, have a problem. They need higher capacity usage to pay their bills. There's a day coming in the next, I'd say, 5 years when we start to see announcements from the oil pipeline companies, we're shutting down this line. It's not economic to support this oil line anymore. Once that starts to happen, those stocks get slaughtered. Now, that announcement might not be for 5 years, although I think that there's one in the Midwest that's a major pipeline that's going to get turned off first. Already fighting lawsuit with Michigan. The oil pipeline companies are going to lose on multiple levels. They can't build anymore. They're not even being allowed to replace lines if there's water nearby, and they're not filled to capacity, and they'll never be filled to capacity ever again. So I kind of sided on that because somebody was asking me about oil pipelines again. And they say, well, I disagree. Well, you're wrong. Because the market is going to recognize this ahead of time. And people will say, well, they fell in price because of the market. Maybe that'll be the catalyst to the first leg down, but then they're not going to come back because the institutions aren't investing in them anymore. And the millennials don't really want them. Millennials want Bitcoin and Ethereum and dog coins. So once again, I'm just going to tell you, the old man stocks, you better get rid of them or you're going to have so much pain when they come down and never recover. One of the things over at FS Insight that I also get, this is a $3,000 a year subscription, is they talk about their asset allocation. There you go. Notice that even in the face of technology getting beat up, they're still heavy in technology. Why would that be? It's because these are the richest, fastest growing companies in the world. And so while people can say, well, there's a sector rotation going on, and there is, right? Commodities are doing a bit better. Cyclicals are doing a bit better. It's not going to be long lasted. It never is. We're 3 months into a move that maybe lasts 6 months. I added a couple of mining stocks, particularly companies that are in the copper and iron, because as we rebuild the world and redevelop the real estate based on the whole new shopping experience that's coming, right? I mean, people say, oh, it's just shopping. Well, shopping is 70% of the economy. So as consumerism shifts to how it's done through the metaverse, on Amazon, different types of store experiences, the real estate all changes too. So we need to keep an eye on that. Now, one of the things that FS Insight is saying is that they believe that we are peaking. Stock market's peaking. This chart. All right. So this is one of their proprietary things that I have actually used something similar for a long time. They say we're basically at the target range where we have to watch for the market to turn over. And while they're projecting a single digit gain this year in the stock market, between, it was like 7 and 11%. They're also saying that could be the other direction, depending on what the Fed does, depending on what other countries do, and whether or not there's a reason for valuations to contract. And they're basically saying it's a flip of a coin. So they want to be bullish because that's their nature, but they're also saying it might be this year that things flip. And they've showed some interesting charts about presidential cycles that show that the market could be rough up until the elections and then a rally afterwards. My concern with the end of the year is that if we get a split government again, and if things aren't in place by then, if Build Back Better hasn't gotten done, we're screwed. Also, there'll be certain rounds of tax loss selling, just like 2021, which was a weird year, was up, but we had half of the stocks in the stock market down a ton, some of which are rebounding handily right now, AT&T, Discovery, Viacom, which are communication stocks that FS Insight doesn't like, but these guys are mainly 1 to 6 month momentum traders. If communication stocks keep going up, they'll just flip the switch and say, okay, we'll ride this momentum. So these guys are essentially momentum traders. They're looking at 1 to 6 month timeframes. The reason I subscribe to this is because I know that's what people demand. They want everything going up all the time. That's fine. Last year and the year before when I was buying AT&T and people were like saying, oh, you're ruining dividend trades for me. Whatever, man. Go buy an oil pipeline. And now all of a sudden, what's AT&T back up to? 27? It's just round and tripping. We have to watch AT&T because, and I flipped this to a monthly RSI reading, longer term range. When companies have an oversold on the monthly RSI, and you can say they're going to stay in business, usually a great time to buy them. Might not be happy for a quarter or 6 months or a year, but these are pretty damn good prices. Jumia, if you're in the commie stocks, Alibaba, Charlie Munger just bought them. Teladoc, On Track. I wouldn't bother with the SPACs because they don't have a long enough track record. I mean, I like the stock. I don't think this particular metric matters given the time frame. Zoom. And Zoom is one that I'm probably going to add to the plug and play mid-quarter because I've been studying them and their cash flow could really grow fast because they're going to be a VoIP leader too. Because guys like me and everywhere else in the world, we're using this as a telephone call now, right? Why would I call somebody when I can Zoom it and do what we're doing right now and share a screen too? And especially if it's, a foreign call. I had somebody call me from the UK on Saturday because their email box was full and they couldn't get the Zoom link. And they were mad. They were like, why aren't we having a meeting? I was like, I've been sending you the Zoom link for 2 days. Oh, yeah. Our email, they're 70 something. Oh, yeah. Our email gets full once in a while. So I think it's kind of funny that anybody has a full email because, who has a limit anymore. In any case, Zoom is going to get all that international long distance, right? We thought it was going to be Skype. It wasn't. Zoom is the winner. Zoom won. It's not going to be Citrix. It's not going to be GoToMeeting. It's Zoom. And everybody's going to have a $15 subscription to this someday. And they're already charging guys like me more. And they've got a VoIP service. And they'll probably get hooked up with a cell phone company. So Zoom is going to be one that we're going to add to the list shortly. I'd say before the end of the quarter, most likely. But the Zoom is going to one I'm probably going to add. Teledoc I already added. DocuSign is interesting. Another reason to have Zoom is if COVID does resurge, then this stock just, it zooms again, right? Now, I've told you, I know DocuSign very well, been using them for way over a decade, way before they went public. I was using Zoom before they went public. The thing with DocuSign is I do think their long-term growth is limited because of how NFTs are developing and how digital contracts are developing. I think we're going to get past the signature phase of the world, right? Just like, people would sign with an X because they couldn't write. I think at some point, signatures become largely obsolete. Exact Sciences, I know them well. Nothing exciting there. I mean, it's certainly a tradable stock. Roku, I think that they have challenges coming. I'd rather own their competitors, the ones that are going to compete with them, or Amazon. Azure Power, look, they're almost overbought on the monthly. And we have a lot of stocks on this list. Square, right? CRISPR Therapeutics. As these stocks get to be in the 30s and 20s on the monthly RSI, just want to prepare you now. You're going to have to use your cash pile to buy these. And it might hurt for a little while because, the shooter will do the best to help us avoid the pain. Itron, I'd love to get into them cheap again. Almost. We're getting there. PayPal. Then when you flip it over, Ford is probably going to stall for a little while. When it comes back, buy them again. Apple, overbought. Tesla's still overbought. So even with a minor correction in Tesla, it's got a lot of room down to go. Berkshire Hathaway is overbought, which is weird because they never get overbought. But it's about as far down as it can go as the middle 200s because they'll just start buying back the shares. Freeport-McMoRan has rallied. So on a pullback, if you believe copper and gold are important, you'd buy it. But I don't know that I want it just yet. Look at all these companies that are still close to overbought on long-term charts. Doesn't happen very often. So if we go to SPY, we change this to a monthly chart, take a look at RSI, this is why we should be afraid. Overbought on the monthly. Always comes down when it's overbought on the monthly. Now, will it get all the way down here? Again, I think it's going to depend on what happens with the Fed. Do they screw up? Are they pushed into screwing up? Or do they tell all these knuckleheads who are trying to talk them into a screw up for the purpose of making a trade? Because that's what they're doing. They're trying to influence the Fed. If the Fed does what I suggested at the start of this call, this will go down, and then it'll zoom right back up over 2 or 3 years. We'll see. The future is bright for the United States. Currencies are relative to each other, and China, Japan, and the UK, Europe in general, the UK too, all have worse demographic situations than us. All of them, by far. If the United States starts running a balanced budget, which we certainly could, anytime we wanted to tax incomes over 5 million as ordinary income, just get rid of capital gains. If your income's over 5 million, it's just income. If we just did that, we'd have a balanced budget along with the minimum corporate tax. That's all it takes. And if we were smart, we'd get rid of all the tariffs and we would just have an import tax for any country that doesn't have a free trade agreement with us. Easy, right? If you want to have free trade with us, then it's free trade. If you don't, there's an import tax. Done. Across the board, mainly impacts China and other countries that we think are, jerks. Russia. There's a lot of easy things that the United States can do. And I would always implore you to remember what Winston Churchill said. I think the exact quote was, the United States always gets it right after trying everything else. It's where we are again. Our economic advantages are so massive compared to the other big 4 economies. And even India, which should be an up and comer. But you should be listening to Elon Musk when he says, look, trying to do this, and they're just, it's just so much red tape and hard to deal with their bureaucracy. I've known this since college, and it hasn't changed in 30 years, 2 generations. It hasn't changed. They're still hard to do business with. It's kind of like how it is in Puerto Rico. There's just places all over the world where the bureaucracies are deep and convoluted and corrupt in spots, and they get in their own way. Puerto Rico, as a U.S. territory, should be the #1 Caribbean destination. Should be. It's not. India should be blazing past China, and they keep getting their own way. Now, I think they figure it out. Maybe. I just don't know how long it'll take. But if the chart for India gets way down here, I guess we buy them again. There you go. So they're way overbought. We talked about them way over here. Now they're way overbought. And it happened fast. That sharpness, it should take a lot longer. But if they get back down in here, we will buy India again. Somebody asked for a Zoom chart. Yeah, I really wasn't going to do that today, but it's in the buy zone. But I'd wait for it to get closer to 100. Because I think that we should be focusing on bottom fishing prices. Because if the dollar suddenly jumps back up, because the Fed does something forward-looking and decides to take control of the market, which is what they should be doing, they should stop kissing the market's ass for a hot minute in time to put down inflation. Because if they come off looking super hawkish by what they do versus what they say, then the markets are forced to react, and then the Fed can pivot. And then everybody in the markets is going to bitch, well, you didn't tell us what was going to happen. So what? Fix the inflation problem, fix the valuation problem, and then let the world normalize for a few months. If I'm saying that, that means they're talking about it. And if you read what 3 former Fed presidents just said, you know that they're talking about it. There are signs that we're going to get a shock from the Federal Reserve. And I want you to be ready for it if it happens. I don't know that it'll happen, but if it does, and it makes sense that it should, we're going to get a whole bunch of bottom fishing prices. All right. Have a good day. I'm going to go help my buddy again. Take care.